But let's get in Abneesh Roy, who joins in from Nuvama Institutional Equities to talk about Jubilant FoodWorks Q4 numbers and the key trends in the QSR space. Abneesh, thank you very much for joining in. Let's begin with Jubilant Food. Your read?
Yeah, hi, good morning. Thanks for having me. Yes, we expect slight weakness definitely in Jubilant Foods. Our topic in QSR space will be Devyani. If you see Devyani, clearly the outlook and overall performance in Q4 and even how they see FY27 sounded more positive. So we do see that Devyani will outperform Jubilant Foods in the near term, medium term. Jubilant Foods is more of a H2 FY27 story. Near term, our sense is Jubilant Foods will see some margin pressure because of higher fuel cost, manpower cost, minimum wages, those are going up. And if you see even in terms of growth, Devyani saw, I think, 14-quarter high growth in terms of SSG in their KFC format, while Domino's clearly saw flattish SSG. I think in March quarter, clearly Domino's did suffer because of the gas fuel availability. Also, we saw even in Britannia. So wherever baking was involved, I think in March month, there was a issue of fuel availability. I think in Q1, even Jubilant Foods will see recovery there. But on a relative basis, we'll prefer Devyani over Jubilant Foods in the near term, medium term.
And valuations of Devyani versus the others?
No, I think there is comfort in valuation. Plus, if you see in Devyani, the merger story with Sapphire also over the next 1 year, 2 year, that will the approvals will come over the next 1 year, and then in FY28, hopefully we'll see the merger benefits also. So yes, there is a re-rating potential in Devyani, given the outlook also, what they have shared and what we have seen in Q4 is better. So yes, valuation comfort is there. Jubilant Foods, yes, it has corrected, but given Q1, Q2, there will be some beat on the miss on the margins. We see that the valuation re-rating potential is in Devyani rather than Jubilant Foods.
Okay, all right. Hi, Abneesh. Good to see you in. Abneesh, what about Grasim? Birla Opus, yesterday the numbers look pretty good on the paints front. They're saying that they've gone ahead and they've garnered close to around 90 basis points of market share as well. What are you factoring in for this year? The reason I ask you this is because they're normally clubbing that B2B e-commerce business with paints when they're reporting. So what kind of revenue growth are you factoring in? What kind of profitability? When do you expect this vertical to turn profitable?
A very good question. So if you see this time Q4, almost every FMCG company, Staples, Pidilite, Asian Paint, Berger, everyone is going to see or has given good results. Asian Paint results will obviously come on May 29th. You will again see double-digit volume growth and good performance overall. So what we are seeing, definitely even the new player is now part of the overall growth story. Yes, first 18 months they have taken market share, but now if you see pricing wise and even in terms of dealer incentive, they are rationalizing, which I think is the right way, because in the initial part you will be aggressive, but then they do have a Q4 FY28 EBITDA break-even and profitability. So if they have to meet that, they have to go towards a more rational policy. My sense is clearly in FY27, all paint players will see double-digit revenue growth. So even for the new player, obviously, we would expect a double-digit revenue growth, which means in the ballpark 20% kind of a range. But even for legacy players, the growth will be quite good in FY27, which is a marked departure from hardly any growth last 3 years. So even we are quite positive on Asian Berger. Berger, in fact, to play the Bengal new government story is one added advantage. So I would say that this paint industry did see disruption, did see very aggressive competition. My sense is now 25% local competition, they will lose market share. Some of the local and smaller paint players also will lose market share. But I think overall Asian, Berger and new player both will now coexist rather than reckless fighting. See, in FMCG paints adhesive, nowhere there is a low competition. So high competition will continue, but it will be a more healthy coexistence rather than just reckless competition. Going ahead.
Okay. ITC will be reporting numbers later today. Quick expectations here.
Yeah, ITC, clearly this is going to be the first quarter of such sharp increase in taxation. So overall volumes obviously will be weak. We saw that in VST Industries, just 3% volume growth. Godfrey Phillips versus earlier trajectory of 25% kind of volume growth, it has cooled off to only 6%. So there is an impact there. On profits, if you see VST and Godfrey both have done well on the EBITDA, but I think that is more of a Q4 one-time event. I think in Q1, all cigarette companies companies will see volume slow down. There will be margin pressure because companies have not passed on the full taxation in Q1. It's happening in a staggered manner. My sense is from Q2 is where the slight recovery on the margins will happen. Yes, tobacco raw material is favorable. Plus, agri business for ITC will be under pressure in March month because of the Iran crisis, and that will be in Q1. So ITC is still more of a 1 year, 2 year where no tax hike will happen, but next 1 or 2 quarters numbers will be weak. But Q4, my sense is company could do well on profits, as we have seen in BST and Godfrey also, because of the one-time taxation change, etc. But Q1, the margins will be weak for ITC. So more of a wait and watch approach rather than that. So our topics in FMCG will remain the same: Nestle, Marico, Tata Consumer. We also like in the discretionary space, Pidilite and Asian Paint and Berger Paint. It's a long list, but we are seeing consumption recovery across the board. Price hikes are happening 3 to 5% in FMCG. Paint companies have taken double-digit price hike, and Pidilite has also taken 13 to 14% price hike. So it's a good year for most of these companies, but definitely ITC will be slightly lower in pecking order.
Yeah, you got to wait, but you get paid. You get paid to wait. That nice dividend, right?
Yes,
That's the
dividend will be good.
Dividend will be good. Anything else in the fringes of your the FMCG, of course, is the core, but in the fringes of your coverage universe, anything else stands out and an absolute return candidate?
I think yesterday Metro reported good numbers after a few quarters. I think that could give absolute upside. They are also talking more positively on the consumption. So we are seeing broad-based consumption. Everyone is talking positively. Even for Page, we are quite positive. So I think these two companies offer re-rating potential also in the slightly retail discretionary space.
Okay, Abneesh, we'll leave the conversation here for now. Thank you very much for joining in. You know, Prashant, there was an interesting note HCL Tech put out on the exchanges yesterday.